Thank you for joining us again. Last week, so this is week 2 of 10. Last week we talked about better education and better data. And then every week as we go through, it's going to be a new topic. And we're going to kind of grow on the topic before. And then that way, if you ever miss one, also, you can go back and watch the recording as well through the Better Life Tribe. So today, we're going to talk about better strategies and better assets. And again, this is talking about how to invest in 2023 because it's a different world than it was even a few years ago, either pre-COVID, post-COVID, and even last year with the rates and different things that we're dealing with. So this is focused mostly on how do we get started today, or if you've already been investing, how do you deal with rates that might be ballooning or just wanting to grow your portfolio and just continue to persevere through real estate investing. So again, I'm Travis Hansen. Thank you for being here. We're at my office in Lubbock, Texas, Brick and Loft Realty. And don't forget the Circle app for questions. And we'll also get to as many questions here online as possible as we go through. So anyway, we got Matt said kudos to the sound person. So Kel, he's still stressed, I can tell. You did awesome, dude. It happens. It happens. He was so worried. He's one of those guys. So, like, the cool thing about the Better Life Tribe and being around like Brandon and Alex and Matt is, first of all, everybody is extremely genuine and kind and nice and understands that stuff like this happens. And I just want to make Kel feel okay. You're good. You did a good job. So, thank you. He worked very hard to get this done. So, okay, better strategies and better assets. So, real estate investing can be, we all know, a fantastic way to build wealth over time. It's essential to have solid strategies in place before we all begin. And today we're going to talk about the key strategies to consider while investing in 2023. So, Better Life, I love being part of the tribe. They wanted a slide deck so bad, but I understand because it helps people at home follow along. And I think it's up on our screen here. I usually just go off the cuff and just talk about my stories and experiences and stuff. So I will read a little bit from the slides, but mostly I'm just going to be explaining what we're doing. So the first thing that I want to talk about is just starting small. So most entrepreneurs, that's the hardest thing for us to do is we usually have really, really big ideas and really big goals. And first of all, most entrepreneurs, we don't think small, we're not patient, and we just want things to happen quickly. We want them to happen big, and we have pretty big goals to smash. But starting small is pretty critical. So don't try to tackle too much at once, obviously, when you're investing. Maybe even start with one single family or a small multifamily, flip a couple houses, and just see how it goes. So like in my experience, my first house, so I scaled up quickly, but I'm going to explain kind of the path that I took. So, and I talked about this a little bit last week. So first house, 2009, third year of law school, I bought a single family home for $34,000. And crazy, crazy numbers. I still live in a market where houses can almost be that cheap, which is awesome. The PITI on that house was like $250. Rent was $750, so the numbers were awesome. The percentage rule, the 2% rule, whatever, 1% rule was awesome. $500 cash flow, and had a 30-year note on it, put it in my own name, and just fantastic. First deal, and I thought, okay, I'm going to buy another one. So scaled up. A couple months later, I had a buddy in law school who had 4 houses. I partnered with him, bought into his deal, and then we bought several over the next several months. We got up to about 10, 15. And then we kind of slowed down a little bit. I graduated, he graduated, we got jobs, he went to a different city. But along the way, I found different partners, different friends, built bigger portfolios, and just kind of went from there. So at one time, 650 units, all single family, multifamily, just a very, very big portfolio. But that took 6 years, 6.5, 7 years between 2009, 2013, 14 time. And that's a lot of units in that short of time with just myself and 1 or 2 partners. There were some smaller syndications of 7 or 8 partners, but most of that was 1 or 2 partners, so or just myself. So just be careful with doing too much too fast. Even if you're thinking multifamily, maybe a 20 unit, 30 unit, starting there and then going up from there. Or, if you do have the reserves, you have the right team around you, which we'll talk about later, there's no reason why you can't go all in and go bigger, faster. But with the rates where they are, 2023, again, that's what we're talking about. Just be careful with that. I'm speaking just from seeing a lot of investors that have come and gone, burned out, failed, lost money. Real estate is one of the least risky investments, in my opinion. However, I have seen a lot of people completely lose a ton, file bankruptcy, and really, really have a hard time with real estate. So be careful with that, because it's not as perfect as it can be. You just have to be careful. And that's what these classes are for, so you have the right roadmap and just know some of the tools that you can do to just have a better approach. So the next one is going to be cash flow. Focus on cash flow first. And I talk a lot about cash flow. We spent a lot of time on cash flow last week, and I'm going to spend a lot on this slide here again, because there's two sides to this, and I want to explain it, especially now with the way rates are. It's pretty critical on the lack of cash flow that we're seeing. So look for properties that have the potential to generate positive cash flow, whether through rental income or appreciation in value, which I will explain. This will help ensure that you can cover your expenses and generate profits over time. So cash flow is king. We hear cash being king, that saying thrown around a lot, but cash flow is king when it comes to rental properties. You definitely don't want to analyze your deal and not think about how important cash flow is. Cash flow is very important, but it's not the only way to make money in real estate. And I don't think that for a lot of investors out there, a lot of investors that are listening to this, should not invest or hold off investing or not get involved with real estate investing because the cash flow, whatever calculator they're using, is not positive or breaking even. And I'll explain that. I had one of my agents come to me after the class the other day, and yeah, she's here. So she asked me how, because I talked about other ways to make money. She said, how are you making money on real estate? Because I've made most of my money off of real estate that did not cash flow, or I did not take the cash flow. So, and the reason I'm going to spend time on this, because 7, 8, 9% rates, or even the hard money loans being even higher than that, I think we all know, especially with increases in value of properties, increases in property taxes, increases in insurance, the PITI that's being kicked out of these calculators, and then the rent amount, because the rent has not gone up with all of these other costs, the cash flow is not there. So that's why I'm going to spend a lot of time with this. But I've made most of my money in real estate without cash flow. So she asked me, what do you mean? How did you make money without cash flow? So I'm just going to give a very simple example on how I make most of my money in real estate. And this is just a strategy that I recommend. But with one caveat, this is a strategy for people that have financial reserves or can feed the portfolio or just be really diligent with expenses, tenant screening, just make sure everything is running really well. Because the cash flow is what makes real estate less risky and lets it just kind of truck along without the monthly hiccups of you going negative. So if you don't have that money coming in and it's not a net positive cash flow, you have to be careful. But with 7, 8, 9% rates, it's hard to do that right now. And I think we all know that. Even in a market like that I'm in, it's still difficult. And I'm in my opinion, one of the best real estate markets in the country. It's still kind of a secret, but now it's kind of starting to get out there. We're seeing investors coming in from all over the country buying real estate here in Lubbock, Texas. But here's the example. Let's say you buy a $100,000 house. I know that sounds low, but those are here. You can buy those here. So let's say you buy a $100,000 house, you put 20% down, so you put $20,000 down, and then you're left with an $80,000 note. So $100,000 house, $80,000 note. Let's say your cash flow on that, the PITI, is breaking even, or maybe $50, $100 or whatever, or maybe even losing a little bit. So let's say over a 3-year period, and this is my strategy, I will let that ride for a while, and the house is in those price ranges that I always buy, and that's anywhere from 150 or 100,000 up to 300,000. That's the sweet spot for me. So let's say 3 years goes by, 2 years, whatever, and that house is now worth $130,000. And then on the other side, that note, that $80,000 note, it got paid down to $70,000. I have a $60,000 swing there with my money. I'm going to go back to my bank and I'm going to say, hey, I have this house, I want to refinance it, and I want to pull some money out. So they're going to go back, they're going to get a new appraisal based off of the last 6 months of market sales, and they're going to give me a new note. So off $130,000 valuation, that's going to be $104,000 of a new note. They're going to pay off the other existing debt, the $70,000, and they're going to give me the difference, which is $34,000. So I may have not gotten a lot of cash flow over those last 3 years, but in a property that I put $20,000 in, which is still there, I pulled back $34,000, which over 36 months, that's almost $1,000 a month in cash flow that I got over those 36 months that I just had to wait for instead of just pulling out cash flow every month. So that house would have never, ever gotten me $1,000 a month on those numbers, maybe $200-300 if I was lucky, if the rates were smaller. I'm talking about the 3-4% rates from back in the day. So $1,000 a month over those 36 months, and the cool part is that money, the $35,000 that I'm pulling out, it's not taxed. So if I was getting regular cash flow, that's income, that's taxed. This is debt, it's not taxed. So that's the strategy I use, and I'll take big portfolios of single-family homes, 50, 60, 70, 80 houses, and I will go back and refinance, and I'll pull out $1 million or more, and all that is debt. It's not taxed, and I just let them appreciate, let the tenant pay down the debt, and I'm able to live off a ton of money that way and make a lot of money. You have to be really careful, though, because when the new debt gets put on those properties, the rent amount also you have to make sure that that's creeping up again, too, so you're not going to be even more cash flow negative down the road. Or if you are, you just do it again for another 3 years and kind of go that way. So that's what I was explaining to her. One of the ways that I've made a lot of money in real estate is that strategy. And then the cash flow, of course, if it is positive, you can still do that with the cash flow, which is cool. And I've been able to do a pretty good combination of both. I just leave the cash flow in the business and never take it out, and just buy more property with it. But you can do that strategy regardless if there's cash flow or not. So don't sit on the sidelines, especially if you're buying in that sweet spot of houses, below the national median in the country, whatever market you're in, or just find a really good market. Don't sit on the sidelines because of rates, in my opinion, because that's a really good strategy to buy real estate. And like I said last week, I do not think that the properties in that price range are going down. I think we're at the bottom. I think we're already seeing them trend up and be more expensive. So if you're waiting for rates to drop, for example, I think you're going to be waiting a long time if and when they drop. And then if and when they do drop, that same house that you were looking to buy or waiting to buy or hoping that the rates dropped for is going to end up costing you $30,000, $40,000, $50,000 more anyway, which could have all been equity and then you could refinance later down the road if rates did end up dropping. So think about that strategy when you're investing, because I see a lot of people on social media and other investors, other real estate influencers, whatever, and they talk so much about how cash flow is absolutely critical, and if you don't get cash flow, do not invest. And for a lot of people, that is probably true if they don't have the financial reserves and they can't stomach the rockiness of having a very, very tight, razor-thin margin. That's probably true. You probably shouldn't invest, especially for the long term, because you're going to get burned out, you're going to get stressed out. So, but just keep that in mind about that strategy. And again, hit me up on Circle if you have follow-up questions on that, or hit me up on Instagram, and I'm happy to answer that as well. My handle is @TexasEntrepreneur, and I'm happy to answer any questions that come up. The next, consider different types of properties. So don't limit yourself to just one type of property. So, and I say this, but I'm also going to contradict myself in just a minute. So, and I'm going to explain why. Consider investing in, residential, single family, commercial, industrial, depending on what your goals and what you ultimately want to do. And the reason I say try looking into all of them, and this is mostly for new investors or other investors that are just trying to expand a portfolio, see what suits you, see what you like to do. When I do my mentoring or my coaching, I try to get people to think of real estate only as a long-term play. I do work with clients that only want to buy 1 or 2 properties ever and keep their job and whatever, and that's fine. That's great. I'll help anybody. But I really like to talk to people that just want to flip the script on their life and really change what they're trying to do with their life. So I try to get people to consider just completely being all in on real estate all the time and just go big and be financially free. So when you think about real estate as a long-term play, you want to, in order to stay in the game as long as you can and actually enjoy what you're doing, you have to find what really suits you. So I used to invest a lot in multifamily, and multifamily did not suit me as a general partner or as a lead investor who had to manage the multifamily. So I still love multifamily. I invest in a lot of multifamily through syndications, but as a limited partner, and I'm happy with that. Residential, single family is what I love, and that's what I found my passion in, and that's why I have been able to do what I've done for consistently over the last 14, 15 years, is because I enjoy it, I find passion in it, it's fun for me, and it's fulfilling. So if you don't have that in your life, you're gonna have a hard time staying in real estate for the long haul, because you're gonna get frustrated. And I still get frustrated over single family, but not anywhere near as frustrated as I got with my multifamily. So a lot of people love mobile home parks. A lot of people love just flipping. A lot of people love short-term rentals. And I've done all of that except for mobile home parks. I haven't done that yet, but I've done almost everything there is to do with real estate. But in order, again, to just stay in it for the long haul, which is what I recommend if you really want to crush your goals, is find something that really, really suits you and you can do for a long time without getting burned out, because it's very easy to get burned out in real estate if you're not careful. Do your research. And I know this is a dumb moment, but yeah, you want to make sure you do your research. You'd be surprised on who out there does not do their research. Before investing in any property, be sure to do your research. This includes researching the local market, understanding the property's condition, potential value, and analyze the financials to ensure that it's a sound investment. So, last week we talked a lot about better systems and better data. And one of the best, you have to think about all that. So we talked about population growth, job growth, median income, school districts, crime rates, zoning, infrastructure. We talked about things like location, property condition, market trends, financing, cash flow. All of that's critical. And all of that, you do all your research, you look at the location, you look at the deal, you look at the property, you look at the lending, you look at the numbers, and it's all going to boil down to one thing, and again, that's cash flow. Are you going to make money on the deal? Is it going to be net cash flow positive, or are you going to do one of those other strategies? So I want to just touch on cash flow again. So cash flow, I like to call cash flow paper cash flow or cash flow. So when you analyze a deal, you've got paper cash flow. You've got your PITI, and that usually boils down to a number. Let's say it's $300, $400, $500. But then you need to think about property management, vacancy rate, damage to the unit, maintenance, and everything else. So let's say your cash flow, your paper cash flow is $500. There's more things that are just going to erode at that and eat at that. Of course, a lot of those, they're all tax deductible, they're all expenses, but if you want to grow a big portfolio and whether or not you have reserves, like a lot of people do the BRRRR method, and they do the BRRRR method because they can get into properties with no money, but then when they have the property, they still don't have any money. And then they have the problem of having a property that's cash flow, paper cash flow positive. They have no money, and then they start getting hit with everything else down the line. And I buy a lot of those properties from new BRRRR investors who get a great deal and they fix it up, and then I buy it from them because they don't have any reserves to actually handle the asset. So I see that all the time. So make sure that your cash flow, your paper cash flow, and your cash flow is what you're looking to do. Your cash flow after all those other expenses are critical, and I see that mistake all the time. They'll get the calculator, which we have great calculators. My partner's building one out now that's going to be available through our business. That's going to be, it's going to be awesome. And you'll be able to use that. Awesome calculators, it spits it out, you get that number, but then they just take that number to heart, they get emotional with it, and then they just get hammered to death after. And just, I'm not trying to scare anybody, it's a thing, and I've seen a lot of investors liquidate their whole portfolio off of just being drained financially, just bleeding properties, and causes big problems. So do your research on that. Make sure that you're knowing exactly what you're really getting into. Build a team. We talked about this last week. This is the most important part outside of boiling it down and finding your non-paper cash flow. So build a team. Real estate investing can be complex, so it's important to build a formidable team of professionals to help you along the way. This can include real estate agents, property managers, lawyers, and accountants. So absolutely critical. So, and also real estate is a lot more fun with friends. So like you'll see, obviously you'll see a lot of real estate gurus or people that are just like doing really well with real estate or real estate influencers trying to discuss and teach you and just get you into real estate. And what you'll see is there's a lot of people usually surrounding them. And we all know what the net worth is your network, saying the show me your friends and I'll show you your future type cheesy stuff. And it's so true. It's so true. And when I go down, when I'm talking about one of the biggest things, the show me your friends, show me your future. One thing that I want to touch on, obviously the people you surround yourself with are the people that you're going to be like, and it's so true. And you want to surround yourself with a good team, but don't underestimate the importance of your family, your spouse, and your really close friends when it comes to this, because they can derail you as well. And I'm not telling anybody to go and get in a fight with their spouse or get in a fight with their friends or tell their family they're disowning them. But you need to be on the same page if those people are going to be around you all the time. And again, this goes back to real estate, me believing that real estate is best if you're in it for the long haul. And if your spouse is not on board, your partner's not on board, your best friend that you're with all the time is not supportive, you're going to have a really hard time in this business. I mean, they're going to, your parents too. I mean, they're going to talk you out of it. They're going to tell you it's too risky. I mean, how many times have you guys heard this over and over by best friends, moms, dads, spouses? That's going to be a big roadblock if you can't get them on board, because it's going to bring you down. And you're not they may erode into your behavior and you may not believe in yourself. So that's why building that right team around you is critical. And you may have to cut some ties. I mean, I'm not saying befriend anybody, but you just need to, if you really want to build a portfolio, maybe distance yourself from some of those behaviors, because real estate investing is really easy. I tell people this all the time. It's so simple to invest in real estate. It's so simple to be successful in real estate. It's the mindset where most people fail. It's building that formidable mindset, shifting your thought process differently than everybody else, that really makes you excel as a real estate investor. And if you're not surrounded by the right people, it's going to be a tough road. So your team should include, and this is the importance that I think, especially, so if you're solo, a solid real estate agent is critical. So if you find a really, really good real estate agent in your market, they usually have access to everybody else that you need. Lawyers, CPAs, lenders, insurance agents, everything. So find the real estate agent. You're going to need a great lender. You're going to need an awesome lender to work with. We have lenders in-house in our business. We think lending is so important. We put one in our building. Jessica Carson with Citibank is one of our in-house lenders here, and it's fantastic. She's able to get deals done for us faster than we could ever imagine. And that's one of the reasons we have a leg up on the competition. Property management companies are critical. They are the most thankless part of real estate investing, but the backbone of a successful real estate asset. Contractors are critical, or a property management company that has really good contractors. Insurance agents, I talked about this last week, but I've seen it so many times, especially with some of the deals that we close as a brokerage. We'll have a deal closing, an investor's buying a house, and then the last thing that happens is we told them, but they didn't get insurance. And then they find out that their $400 cash flow, once their insurance is added, goes down to $100 or it's zero. So again, insurance is so important to us that we put insurance in-house. We have Grimes Insurance with Ryan Reynolds in-house here because it's critical. You have to have a good insurance agent. And then a title company. You have to have somebody that has great underwriters, easy to work with, can solve all your problems for you. CPAs are awesome. We have bookkeepers in-house that do the numbers, but then we have our accountants that really, really elevate us to do the right thing when it comes to following the rules of the IRS. And one of the reasons most of us invest in real estate is to pay less in taxes. So have a great CPA, have a great attorney, and then lastly, it's your partnerships. You have to have great partners around you. You're not always going to agree. You're going to have different thoughts on things, but at the end of the day, you just have to have people with the right mindset that truly want to grow. Some of the things you're going to want to do are going to be different, but most things, as long as most things are working. And partnerships are like marriages. You're not always going to get along. You're going to have issues, but you just have to have really solid people around you that can guide you and support you and motivate you and everything else. So I think Kyra and I did some Instagram posts today, and one of them was like, what motivates you? And I talked a lot, I'm looking at Kyra, but I talked a lot about the people around me. The people around me motivate me, and my agents motivate me. Coming to the work, and it's always the same great people here, and it's just so fun to come and hang out. And that's part of it too. It's just all of your clients, your people, everything. It's just huge if you want to stay in this game for the long haul and do really well with it. And then the last one on here is take advantage of technology. This comes back, I'm going to talk about the partnership part of this, as I have one of my partners, Travis Lanning. He loves the technology part of this. He checks the box for our partnership because he's always looking for the next best technology to use and the best new banking relationship, the next best everything that just syncs everything together. And it's massive because I'm terrible at tech. I don't know what Cale was doing running around trying to get the sound going. I'm just sitting here waiting, and he solved the problem. So just have the right people in play that can just do everything for you and make your business a lot better and stronger. We're going to go through the closing thoughts on that. The next half, we're only halfway through, but the next half is really short, half in pages, but not half in time, and then we'll go to questions. So, and I promise that if we get lost on time, we'll go back to the Circle app, and then you can also reach out to me directly, and I'll answer your questions, I promise. It may take a day, but I'll answer them. So we're going to talk about better assets. What kind of assets are out there and what we want to actually look at. So multifamily properties, they're probably the most popular form of real estate investing out there, especially for new beginners that are just really trying to figure out what to do, because it's the big thing on the block, it's the popular thing, it's what most people are doing, and it does have the tendency to make a ton of money. Multifamily properties, such as apartment buildings, are a popular asset due to their potential for consistent rental income and long-term growth. And these are trending up, especially in big cities. Like I said, I don't invest directly in multifamilies as a general partner of any syndications or as the lead investor here in my market. But I love multifamily as a limited partner. I love to have smarter people than me just take care of it and go that way. One thing with multifamily, I think they're really good with big cities. I mean, they can be good with small cities too, but Class B areas, Class B buildings and above is what I would recommend. A lot of people love Class C. That's what I used to own. Beware of those. If they can just cause a lot of headache, and the tenant base is tough, and everything about them is tough. However, the cool thing about Class C, or even distressed Class B and A, most Class A are not distressed, but the difference between multifamily and single family when it comes to making money is that they are appraised completely different. So let's say you get a 100-unit distressed Class C or a distressed Class C multifamily asset. A single-family home is generally appraised off of the 6-month looking back market value. You have to just go with whatever the other houses in that 6-month time period and in that little radius are selling for. Multifamily, if you find something distressed, the appraisal is somewhat off of the other apartments in the area and the community around it, but you can really skyrocket the value, the after repair value, the ARV, by just raising the rents and improving the property. And you can do that astronomically high compared to single family homes. It's really hard to get a higher appraisal on a single family home just because of what the rent is. But with multifamily properties, let's say you buy $1 million asset that's distressed, you could push that ARV all the way up to $3, $4, $5 million if you can get that rent up on those individual units. So it's pretty impressive how much money you can make in multifamily. And I've seen people make a killing off of distressed multifamily by finding it really cheap, putting a lot of effort in fixing it up, and just making millions of dollars off of one deal. So it's a lot of work, it's more complex, it's a higher barrier of entry, but it is an awesome investment if you know what you're doing. So industrial properties. This is an investment asset I've never invested in, but I've been looking at it recently, because every time I mean, you always hear about another store closing. I don't know. I can't remember the last one. It was some furniture store, some appliance store. I can't remember, but it was a big Bed Bath & Beyond. So you're always seeing these brick and mortar stores closing all over the place. And all of that is just shifting to the Amazons, Sam's Clubs, Costco, Walmarts, all these big organizations that sell everything online. And I don't know if you guys, I mean, you guys probably, it's pretty blatant that like on Amazon, you buy something on Amazon or even Walmart or Costco online, it used to be 4 or 5 days you were waiting to get whatever you bought. I mean, even in Lubbock, which is kind of like, if you guys look at a map, Lubbock, Texas is like so far away from any other big city in Texas. We're still getting stuff the next day. We're getting stuff in 2 days, like at the latest. Sometimes it'll be 3, but it's very rare. That's because massive industrial buildings are going up all over the place, and that's what these companies are using to do this. And a lot of those are obviously owned directly by those companies, but that doesn't mean that other Amazon third-party sellers or even Costco, and I don't think Costco does it, Walmart does it, and other companies, Target I think does, they have third-party sellers, and they're going to invest in these warehouses, and I think that there is some place for that moving forward. And I don't think a lot of people are really buying those right now. I know nobody in my community that I know that I talk to directly are buying those or building those, and I think that's and they're so much cheaper to build than a multifamily. I mean, you just build a massive warehouse, throw a few bathrooms in it, and you have a business. I mean, you have a giant warehouse you could use or rent out to somebody that's doing this. So senior housing is huge. It's going to continue to be huge. That's not going to go away. We know that. It's been trending up for a very long time. When I used to think about real estate, I used to only think about single family and multifamily. The industrial stuff, the mobile home parks, and I do a lot of student housing too, because Lubbock is home to a major Texas Tech University, major university. So, but senior housing is becoming huge. In fact, I have a buddy in California that his goal is to get 10,000 beds in the next few years. So he's really going all in on senior housing. So I listen to a lot of podcasts, and I don't know how true this stat is, but you guys probably know Peter Attia. He's a really popular doctor. I think he was on either the Rich Roll podcast or some other podcast, but he was talking about longevity and longevitists that they are claiming that for the infants that are being born now, for every year that goes by, it's either a half a year or a full year longer that those people are going to live into the future. And he's thinking like some of the people that are being born now may live to be 150 years old. That's just crazy. That's insane. So just stay away from 401ks is all I can say, because that is not going to do it for you. Imagine 150 years old and trying to live off a 401k, or you just have to work till you're 120, I guess, to have that 401k pay off for you. But thing with real estate, let's say a new baby was being born, and then you just start buying real estate for your kids, for example, and by the time they're 30 or 40, they have enough property they could retire, and then they could be retired for 100 years instead of 50 or 60. So it's pretty incredible, because real estate, it's just going to keep going. It's crazy. So 150 years old, I don't know if I want that. Student housing, we all know student housing's critical. I mean, no matter how much I talk about college being terrible, people are still going to go. So a lot of people are still going to college. College is great for a lot of people. It's probably not great for most people, but I don't think that matters. I think people are still going to go to college until they realize, there will eventually be a trend over the next decade, maybe 2 decades, where people realize that, let's be honest, most people go to college really because they want the experience. Everybody's doing it. It's what everybody's always done. But then they're spending 4 years in college, they're paying $100,000, $200,000, and they're getting a $50,000 job. That math does not work for me at all. And I feel like I can dig on college a lot because I have a bachelor's, a master's, and a doctorate, and I don't know if I wasted time or not. So, but because I know everything I do now I can do without any of my college education. So, I don't know if college is the best thing, but I know that people are still going to go at least for the next decade, 2 decades. I think the trend will change. So student housing, I think, is always going to have its place for a while. So, I mean, these universities are, like in Texas, like Texas Tech, I think is 40,000 students. UT and A&M are 50 or 60, 70,000 students. It's just crazy. There's just massive schools. So, and I know that those places are There's very smart, very rich billionaire investors going all in on student housing in Austin, for example. So they know a lot more than I do. Office buildings, we know that there was a pause in office buildings. That did stop for a while, but I think that a lot of people are being, after COVID, they're kind of sick of being at home. I think people do like to be in a community. They like to socialize. They like to be with people. I think a hybrid is going to be more prevalent than before, but I think a lot of people are going to be going back. So with office buildings, though, just like with single-family homes and multifamily homes, location is key, because I think every city, I know that Lubbock, for example, is having, a lot of new buildings are being built, but a lot of the old buildings in bad areas are just abandoned. So you just want to make sure that if you're going to build something or buy something, that it's in an area where it's trending up, and just, again, that's common sense, but don't buy an office building off the freeway in the bad side of town because you think that it's a good deal, because it may sit empty forever. I've seen that a lot, and I've seen people lose a lot of money with that strategy, so you have to be careful. And then my favorite is single-family homes, the most boring part of real estate investing. However, I have done this for a decade and a half and very consistently stayed in it. A lot of people don't like single-family homes. They think that it's, I know the reason I know that there's a lot of, and even some of my friends who are big apartment people, big multifamily people that just have hundreds of units or thousands of units, and they, until they met me, I hope, they claim that you can't create wealth with single-family homes, but you absolutely can create massive wealth with single-family homes. I've done it, my partners have done it, I have other friends that have done it, and it's very possible. The barrier of entry is low. You just start small and you just keep buying them and buying them and buying them. And I actually think there's a lot of advantages to owning 200 single-family homes, for example, or 200, one big, nice 200-unit apartment complex. And a lot of it goes back to the strategy of, if you have issues with cash flow or tenant problems or like a COVID type issue or whatever, let's say your cash flow is struggling a little bit, rates go up or whatever, your notes balloon, you have 200 single-family homes. What I've done is let's say I need $500,000. I'll just peel off 50 houses, I'll refinance those or sell those even, and get the money that I need. It's a lot harder to do that with one big multifamily, because multifamily, the only way that you should sell multifamily is when it's at the best place to sell it you could possibly be at. You need to get everything ready. You need to make sure your NOI is good. You need to make sure your current trailing 12 is good. You need to make sure that your pro forma looks good. That's the way to sell a multifamily. That takes effort and planning and diligence into the future. Where a single family, you just go off the market. There's always a demand. You just peel off whatever houses you want to buy, you sell, and you make the money and you move on with your life. So there are some really good strategies with single family outside of just that one big apartment complex. But again, don't get me wrong, I do love multifamily. I just am always going to be a very strong advocate for single family. So, okay, that's it. Questions, sorry. We got through some hiccups, and I wanted to get to some questions. And we can go a little longer if they don't kick us off of Zoom. So I'm happy to answer them here. And I'm also happy to answer them on Circle again, or on my Instagram at Texas Entrepreneur. Definitely hit me up. I will answer them. Kyra will tell me that they're there. There she is. Nate, how do I convince two of my friends to partner up with me to buy a Burr property in Lubbock? Is Nate here? I don't even know Nate. Does anybody know Nate? Nate Willard? He wants to buy something in Lubbock. Are you a local guy? I don't have the cash, but I have he's not local. Okay. I don't have the cash, but I have the construction knowledge to fix everything up. What's in it for them, and what is pursuing a partnership? Well, if you don't need them, you can go solo. Why do you need your friends? If you have all the construction knowledge and it's a Burr, generally you can do that without any money if you find the right deal, and we can help you find the right deal. I have a couple of the best real estate agents in Lubbock here listening right now, and they can help you get that deal. We find people Burrs all the time. So if we can find you the right deal, you won't even need your buddies. But it's definitely easier with more people, and it's more fun. And the thing that's great about a partnership, if like you and your two buddies formed a partnership of the three of you, you could probably go after 2, 3, 4, 5 deals at a time. So that's the benefit. And I would just show them the numbers. Show them what you can actually do with a good BRRRR. Get David Green's book about BRRRR investing and have him read it. Let's see. Francis helping me answer the question. Thank you. Hey, Travis. Dan. Hey, Travis, what are your thoughts on new builds, particularly new build singles and small multifamilies? Do you get into new builds at all? Why or why not? I love new construction, Dan. I own several new construction. So new construction is tricky though. You have to make sure that it's in the right market, because new construction can cost astronomically high. So in my market, for example, I buy new construction as low as $200,000. Brand new, 3-bedroom, 2-bathroom house, 2-car garage, all brick, in a good area, good school district. The property taxes are a little high in Texas. That's the only issue. They don't cash flow very well, because let's say you have a $200,000 property, you're putting $40,000 down generally. They're only going to rent for about $1,600, $1,700, $1,800. So you're not even hitting that 1% rule. But I think these houses that I'm buying are going to be worth $300,000 in a few years. So I love, love, love new construction. I don't have any experience with new construction on multifamily. However, I think that there's a place for it. You just need to make sure your numbers are good. But new construction is probably not going to cash flow that great anywhere right now, just with the rates. And the rates may stay the same. So you just need to find different strategies to make money with real estate. So. All right, any other questions? Let me see. Let me scroll through. Michael asks, what are the attributes of a great real estate agent? So I am a real estate broker. I would say I am a terrible real estate agent. So I'm going to tell you what's bad about me, like why I'm not a great real estate agent, and what the attributes of a great real estate agent is. So everything opposite of what I was like. So, what I've learned mostly about real estate agents, the really, really good ones, and we've got a few in this room right now, is that they're always, first of all, they're always on the phone. Like my partner, he's one of the best. He's always on the phone. They answer every call. They return every call. Maybe not right away, but they just get with people all the time. I can ask him I can do this too, but I can ask him specifically what neighborhood, what's the price per foot, what the properties are going for, what the market conditions are. They have so much information and so much experience in that area that they just know everything, especially with investing. They know how much it's going to rent for. They know they can almost do the entire PITI in their head, or just whip out their phone and just do it real quick, and they'll just know exactly what the numbers are. But really, it's just they just know the market, and they also have good contractors at their disposal. They have good lenders. They have good insurance agents. They have that team around them just because they sell so much volume that they're able to give you the resources that you need, property management companies, everything, to actually have a successful investment. So that's what I would do. I just find for somebody that is really seasoned with investments, because there's a lot of great real estate agents out there that buy and sell, that do buyers and seller stuff, but not investments. So this is an investment class. Find somebody that's specific to real estate investing. If you are buying properties that don't cash flow, what money are you living off of? Okay, so Emily, I answered this a little while ago on my strategy on how I make money without cash flowing real estate. So first of all, I think you're asking me specifically what money am I living off of, but I don't think that's what you're asking. I think you're just asking in general. So that's why I say with non-cash flowing real estate, you have to be careful. So cash flow is king. You have to have cash flow if you're a new investor, you don't have reserves, and you don't have a job that's making money on the outside. If you don't have a job and you don't have any reserves and you're just trying to BRRRR properties or whatever to build a portfolio, and that's the career you're trying to go into, non-cash flowing real estate is probably not a good idea. Non-cash flowing real estate is for people that do have the reserves, that have extra money, have the capital to actually carry that investment forward, because they are going to have to feed it eventually. Even new construction, where there's builder's warranty and everything, there's still going to be vacancies, there's still going to be issues, so there's still going to be problems that you're going to have to feed down the road. So be careful. I love non-cash flowing real estate. That's where I've made most of my money, but I have other businesses, other ventures, and everything else that's allowed me to have the capital to deal with that. So just be careful with that, Emily. You don't want just buy a bunch of, because going back to the people that burr, like a lot of these young guys that are burring, and they think they're so great. They're getting all these properties with no money. They're just like building all this paper liquidity that they can eventually sell. But then they get their asset going and they want to have it as a rental, and then problems come up and they can't cover any expenses. So you have to be careful with that. So then people like me go in and buy them from them at a discount because they're not careful. They're not thinking it through. So be careful with that. Let's see. All right, guys, a lot less questions today. I'll take it. But definitely get on Circle if you have any follow-up questions, or on Instagram, and I will answer the question. Is there one I'm missing? I'm at the bottom, I think. Is Wendy the last person on there? I have Michael as the last person. Okay, now I've got a new one. Okay. Along the lines of Nate's questions, if you were to bring in other partners with capital, what are ways you can structure a deal? So if you're going to bring in partners with capital, then that makes it all better because you don't have to generally or necessarily burr. You can just go out and buy properties. So I have a buddy that's actually moving to Lubbock, and he and his partner, they have some money capital that they're just going to have, some other partners that are just being the money people. They're going to be the boots on the ground, and they're going to build an entire portfolio off of that money. Two people are going to do all the work without putting capital in, and the capital partners are going to be putting all the money in, but they're all splitting everything equally. So I think that's a solid way to do it, because these guys with the money, they desperately want to buy real estate, but they don't have anybody to build their portfolio. And these guys, they have all the knowledge, the construction knowledge. They're here. They can actually do all the work. So sweat equity is huge. If you can find a money partner, and you can do all the work to get the deals going. So, how do you feel about buying properties in your personal name with a mortgage and then deeding them to your LLC after closing? I think that's great. So that's one of the reasons it's nice to have a lender in-house, is that we can get our clients to this lender, to Jessica, and she can get them the property. They can put it in their own name. They can buy the property and go along their way, and then they can work with the title company on the back end. So just make sure you're following all the current rules and regulations on how that works, and get that done. So I don't recommend keeping it in your own name for a very long time unless you really know what you're doing, because you can be sued. If you guys don't know, I'm an attorney by trade, and I got to be careful. I just like to say that to everybody, so be careful with that. Is there any scenario where you would increase the amount of money down in order to generate cash flow? Absolutely. Or would you rather break even with only 20%? So in your calculators that you're using, obviously the more you're putting down, your ROI is going to shrink. That's the only thing. If you're fixated on a specific ROI, a number ROI, let's say with 20% down, it's a 4% ROI. And that sounds terrible, but that's really what it is with the negative cash flow. And let's say you put 30 or 40, 50% down, and your ROI shrinks to like 2%. You're forgetting all the other areas of money that you're making. First, you're making the depreciation on your taxes. Second, you're making the appreciation. And then third, you're making money on the tenant paying down your debt. So even if you have a 2, 3, or 4% ROI, you got to think of all that other money you're making. Let's say in 3 years it increases $60,000, and then $30,000 of debt is paid down. That $90,000 is quite a bit of money that you can make on a refinance, which is debt, non-taxable, that will increase your ROI on the back end. A lot of people don't think about it that way, but that's how I think about it. And I think that tenant pay down contributes to the ROI. I think the appreciation contributes to the ROI, and I think that that's something you should think about. What are some common pitfalls to watch out for if we deed the property to an LLC after? Just the cost. I mean, you're going to have to tell your bank. Your bank's going to want to know what you're doing, because it's going to change. The mortgage that you have is going to change from one name to another. So you want your bank on board. You don't want to do it without telling them. I mean, they're going to find out anyway, because the title company is going to do a title search. So you just want to have everybody on the same page, and just know that it's going to cost money. It's not free. Title company's going to charge you something. Bank may charge you something. There's some things that are going to be at play there. Okay. All right, guys, you guys know where to find me. Please, Circle app, get me some questions. I will answer them. And on Instagram, at Texas Entrepreneur. Happy to answer all your questions. And I'll get with Alex Felice in Maui to make sure that he is going to put that on Circle so you guys can hit me up and we can just chat. All right, guys, I think we're good.